Good morning, ladies and gentlemen. I think you all know me. I'm Mike Harding. I'm the Chairman of Horizon Oil Limited. Before beginning the meeting today, we acknowledge the traditional owners of the country in which we meet today, the Gadigal people of the Aurora Nation, and we pay our respects to the elders, past, present, and emerging. I would like to welcome you and officially open our annual general meeting for 2022. I'd also like to extend a welcome to those members who are joining us by webcast. Do we know anybody has joined by webcast?
I think we have.
Okay. Based on the number of voting members in attendance, I declare a quorum for this meeting. Before I commence today's proceedings, I would like to draw your attention to the safety procedures for the venue. Should you hear an alarm, the instructions will be broadcast by the building wardens regarding what action to take, be it remain in place or proceed to evacuate. If you're required to evacuate, please make sure you don't use the lifts, and the evacuation point is located in the forecourt of Banger Tower 3, as indicated on the map. I would now like to introduce my fellow directors. On my far left is Greg Bittard, Bruce Clement, and the Chief Executive Officer, Richard Beeman. On my right is Nigel Burgess and Sandra Berkensley. And also joining us are Company Secretary Bass Martin Kakas. Did I get it right?
Perfect.
I note that Sean Ruggers, representing our auditors, PwC, is also available today to answer questions on the auditor's report later in the meeting. Before beginning the formal business of the meeting, I would like to ask our Company Secretary, Bass, to outline today's procedures and protocol.
Thank you, Mike. All resolutions will be decided by way of a poll at the end of the meeting. The meeting will consider the items of business outlined in the notice of meeting sent to all shareholders 17 October 2022. There will be opportunities for shareholders to ask questions and will be confined to the formal business of the meeting. Only those persons holding a yellow or blue card are eligible to ask questions. Gemma Coyle of Computershare has been appointed as the returning officer, following confirmation by Computershare. Final proxy and voting results will be released to the ASX and the company's website later today. I'll now hand back to the Chair.
Thank you, Bass. As there may be shareholders available today who can't stay for the entire meeting, I now declare voting open on all items of business. Any undirected proxies in my favour as chairman will be voting in favour of the relevant resolution. The meeting will consider the items of business outlined in the notice of the meeting sent to all shareholders on the 17th of October 2022. I would like to start the meeting with my formal address. This will be followed by the CEO's presentation. There will be an opportunity to ask questions on the presentation, and then we'll proceed to the formal part of the meeting, where resolutions providing the notice will be put to the members. So, ladies and gentlemen, Horizon has again posted a strong set of results for this financial year. Similar to last year, coupled with a strong balance sheet, consistent low-cost production and cash generation, we're pleased to return a further 3 Australian cents per share to shareholders made up of the dividend and capital return. Our strong results produced the sustained production levels from our Maari and Block 22/12 assets, which are of course aided by the higher oil price. Our assets in China and New Zealand are high quality, and our aim is to continue to maximise production and cash flow through workovers, infill drilling and other production enhancing initiatives. We were also pleased to commence production from our new 12-8 East field development, with first oil being produced in April 2022, only 18 months after FID was achieved. This development has been a success, which has led to an immediate second phase of development drilling, which is currently underway. I would like to take this opportunity of thanking Chris Hodge for his time as CEO, and I'm particularly pleased to welcome the promotion of Richard Beeman to CEO. All subsequent executive movements have been filled by internal staff. In this regard, I would like to acknowledge our new executive team, comprising of Gavin Douglas, our new Chief Operating Officer, with your hand, where we're now Kyle Keane, our new CFO, and our Chief Financial Officer is Kyle, and Bass Martin Kakas, our new Company Secretary. In regards to the health and safety environment, I'm pleased to announce that for 2022, Horizon achieved a total recordable injury frequency rate below the Australian NOPSEMA industry average, with a lost time industry frequency rate of zero fatalities or significant environmental incidents in 2022. The Bayboy operations achieved a strong safety record with no recordable safety incidents despite significant drilling, production and project development activities during the period. The Maari operations similarly achieved lost time industry frequency rate of 0 and 0 environmental incidents for the period. I'm pleased our lenders, ANZ, Westpac and ICBC, continue to support Horizon with recently announced extension of our debt facilities. The company has also moved offices, with the new office providing a smaller footprint more appropriate to current staff levels. Not only does this allow for some further cost reductions, but it provides a team with a refreshed new office space, helping to foster a more collaborative working environment. Looking to the future, we will continue to work to maximise production and value from our producing assets of Block 22 China and Maari in New Zealand, and continue to actively pursue infill well drilling, other production enhancing initiatives, and our producing assets which are providing excellent value. We will continue to review our cash position regularly to consider further shareholder distributions, whilst always keeping an eye out for other opportunities. We've continued to progress work on enhancing our ESG strategy, particularly in response to growing climate change related concerns. We acknowledge the part we have to play in increasing our and hence our sustainability. This year, our report, which transparently discloses our impact on the action we're taking to a more sustainable company. To this end, earlier in the year, we announced our ambition to achieve net zero GHG emissions by 2050. We will continue to refine our roadmap for achieving this ambition. Our CEO, Richard Beamont, will say more about Horizon's performance shortly. He'll also update you on the company strategy. Richard and his team are to be congratulated with their achievements in 2022. Bruce Clement, together with myself, are seeking re-election today. Bruce and myself are unanimously endorsed by the board. Finally, I'd like to thank our shareholders for your valuable support during the year. I will now hand over to Richard to present the CEO's report before returning to the items outlined in the notice. Richard?
Thanks, Mike. And look, it's lovely to welcome everybody to what is our first physical AGM in quite a few years. Firstly, I'd like to just turn to the disclaimer and compliance statement, which relates to today's presentation. And look, today I'm just going to go through and basically outline and reinforce, I guess, the company's strategy, give you an update on our operations and some of the key highlights for FY22. So Horizon's company strategy is fairly simple. We aim to maximise free cash flow from our assets. We aim to further provide distributions to shareholders when it's sensible to do so. And we want to continue to invest in production growth, focused in and around our existing asset portfolio, but continuing to keep an eye out for opportunistic growth opportunities. Importantly, we're delivering on this strategy. So in FY22, we had very strong cash flow generation, driving EBITDAX of roughly $73 million. And our ability to generate such strong free cash flow is really underpinned by our very low operating costs, sitting at just under $20 a barrel. But obviously that was enhanced by a very high oil price, sitting at around $90 a barrel through FY22. This strong free cash flow generation has helped us to deliver significant distributions to shareholders, with consecutive returns of 3 cents per share over the last couple of years, which roughly equates to 40% of the company's market cap, or about a 20% distribution yield over the last 2 years. Notwithstanding these distributions, we continue to focus on production growth. As I said, focused in and around our existing portfolio. And we were very pleased earlier in the year, back in April, to commission our first new development in some time, the 12-8 East development. And we've had very, very strong production rates from that field. That's been enhanced further with infill drilling and additional workover activities. And we're now seeing combined production across our portfolio of roughly 5,000 barrels of oil per day net, which is an increase of some 40% on the prior financial year. Just to put that into perspective, we're currently generating revenues of about $500,000 a day, and that's up from about $300,000 during FY22. It's our objective to continue to mature further opportunities in those assets to really drive and sustain the production levels from our assets. So let me briefly recap FY22 and point out a few highlights. We had over a 70% increase in revenues to over $108 million. over 100% increase in EBITDAX to 73 million, over a 200% increase in underlying profit, and importantly, this drove over 100% increase in cash flow generation, which helped facilitate the distributions I mentioned earlier. As Mike mentioned, we managed to extend our debt facilities with ICBC, ANZ and Westpac. And operationally, I've already mentioned the successful commissioning of the 12-8 East development. But I think it's really important to recognise that that field, we took FID only 18 months prior to that field coming online, which is really a testament to the capacity and ability of our operators in the joint venture and the contractors involved to be able to bring that facility online within 18 months, notwithstanding the pandemic and the various supply chain challenges. On ESG, despite the elevated activity levels, we continue to uphold a strong safety record, significantly better than the benchmarks. And on climate change, as Mike mentioned, we declared our ambition to reach net zero by 2050 and are developing a roadmap to achieve this. We enhanced our governance in this area with formal ESG oversight by the board, supported by a sustainability steering committee. And for the first time, the group purchased over 15,000 tonnes of voluntary carbon units to offset the majority of our Scope 1 emissions at Block 2212, whilst continuing to offset or to purchase carbon credits for 100% of our Scope 1 emissions from our Maari field. Going forward, our desire is to focus on further direct reduction, carbon emission reduction initiatives at both of our fields, and we continue to encourage the operators of our fields to perform that. As part of our overall decarbonisation strategy, we continue to evaluate various institutional grade carbon removal projects. However, for any project to be considered, it's got to have positive and appropriate investment returns. So just moving on to the next slide, we've got here a snapshot of the share price over the last 12 months. Horizon's share price in the red or orange, the oil price in the green, and the ASX 200 energy index in the grey. What you can see is we're clearly heavily leveraged and linked to the oil price, but importantly, we've outperformed the ASX 200 energy index by quite some margin, noting we had the 3-cent distribution quite recently, which obviously brought us back in line. Just a word on oil price. About this time last year, the oil price was floating just over $70 a barrel, and now the consensus is for it to remain, at or about the $90 barrel mark. Notwithstanding the higher oil price, we've seen significant underinvestment in the sector, and whilst the sentiment has shifted away from fossil fuels, it's clear that oil is going to be necessary in the energy mix for quite some time to come. Accordingly, it's our general view that oil prices will continue to remain relatively elevated, really driven by those supply side pressures, but also due to the continued strong demand for hydrocarbons. So now to an update on the actual asset portfolio, starting with Block 2212 in China. If you just turn to the next slide. This slide's got a couple of good photographs of the 12-8 East development as it's come to fruition throughout the year. Again, just really want to highlight the success of this project and what's been involved here to get this project online, notwithstanding lockdowns in China, the pandemic, supply chain challenges, inflation, you name it, everything's been thrown at us. So, really is a testament to the joint venture and the contractors involved to get this field online. So just now moving on to the next slide. As you're probably aware, Block 2212 consists of about 20 odd wells spread across 8 different fields, as shown in the green squares in this slide. The geographical spread helps to diversify the portfolio and really de-risk the asset, as we've got cash flow coming from each of the different platforms. Whilst historical production has been dominated by the 612 and 12-8 West fields, which are the top green box in the bottom left for you. And production from those fields has generally been averaging about 8,000 to 10,000 barrels a day over the past, call it 9 years since production first commenced. It's this box off to the right, the 12-8 East field, which has really been the core driver of production growth over the year. So we're now seeing production rates elevated at about 15,000 barrels of oil per day ever since the cleanup of the 12-8 East field occurred around about July this year. And our objective is really to continue to sustain that production from that field. So that's almost a 50% increase in production rates out of this field. This field generates about 70% of the group's cash flow. And that's heavily driven by the very low operating costs, which for FY22 sat at around $13 a barrel. Very low indeed. So looking at the 12-8 East development in a little more detail, there's a 3D diagram on the right which shows the key elements of the field. You've got 6 production wells and 1 water disposal well, and the lease platform sitting over the top. That's all tied back through to the 12-8 West field via a dedicated pipeline. As I mentioned, that field successfully was commissioned in April this year. And what was very pleasing was we managed to keep the development costs on time and in budget of around about $20 million for our share. The field's been producing very well, and as you can see, it's generated about 8,000 barrels of oil per day on average over the last 3 months. And we expect it to contribute at least an average of 4,000 barrels of oil per day for the first full year of production. Importantly, the early success from this first phase development has given us the confidence and courage to go with a follow-up phase 2 development. And so we're currently drilling ahead with 3 to up to 5 new production wells into the field, which will further enhance the production rates. Just to look at this phase 2 development in a little more detail, as I mentioned, it's 3 to 5 wells, and they're depicted there in the black as the likely well locations. I'm pleased to announce today that the first of those wells has already been drilled and completed, and it should be turned on to production in the coming days. That subsequent phase of development will add about 200,000 barrels to our 2P reserves, and again continue to help us to sustain those high production rates of around 15,000 barrels a day, certainly out into the new year. Other recent activity at Block 2212 has been focused on infill drilling. We had 2 wells which are depicted in the red line there, the A10S1 and A12S1 wells. Those wells, both successful wells drilled and completed, again helping to sustain production rates. We also had a very successful workover program in September, which again to sustain these high production rates. Just move on to the next slide. This slide really just helps to sort of show the further opportunities across the field. You've got there a number of orange and yellow dots. The orange dots represent the wells that were drilled during the current year, but the orange dots, or the yellow dots rather, represent all the remaining infill well opportunities and further near field prospects that we see right across the Block 2212. So it's our objective to continue to look at drilling some of these opportunities to continue to sustain those production levels, which segues nicely to the next slide. This is probably my favourite slide of the whole deck because it really helps to demonstrate what our objective is and show you how we've been successful in this field over the past 9 years. So what you've got there in the dark green is essentially our 2P reserve forecast, and in the blue is our indicative future activities. What we're trying to show there is, in the past, we've had a very successful run of being able to conduct infill drilling, workover activities, upgrades to water handling capacity and the like, and really maintain production at or about 10,000 barrels a day for the last 9 years. You'll see that we've been quite successful in recent months in really accelerating our development efforts and boosting production rates, as I mentioned, about 50% above the average of the last 9 years. And we're not done with that. So there's further infill wells proposed in the pipeline, upgrades to water handling capacity, and other initiatives that we've got in the pipeline, which are all aimed at trying to sustain those higher production rates. I would just point out they're not a given. They rely on joint venture approvals, proper economic assessment. We rely on elevated oil prices being sustained and indeed rig availability. But certainly, that's our core objective. So turning on to New Zealand, the Maari field continues to be a very important asset for the group, contributing about 30% of the group's cash flow. Importantly, over the past few years, the decline rate here has been arrested through consistent and constant water injection into the field. And perhaps the key difference with Maari over our China fields is we don't need that continual investment in new wells in order to sustain production rates. The water flood into the field helps to maintain pressure and continue sustaining production rates. Our operating costs are relatively modest here in the sort of mid-$20 a barrel mark, and as a result, this field continues to be highly cash generative. Maari crude attracts premiums to the oil price, and most of the oil is sold into the east coast of Australia. We had a number of workovers during the year, and we've had some challenges due to COVID in getting those wells back online, but we expect those wells to be progressively reinstated over the coming months ahead. And with the termination of the proposed divestment by OMV of their stake in the Maari field, we look forward to working with OMV to continue to extract maximum value out of the asset. Now, similar to the China field, here's another slide showing really the production performance and our view of the asset going forward. Again, the dark green is essentially the 2P reserves, the light blue, potential indicative future activities. I would just highlight with Maari, you've got the notional end date there of 2027 for the permit. And so getting an extension beyond that date is quite critical in order to go after some of those future activities. But there are talks already afoot within the joint venture to look at an extension to the permit. So just looking to the future and what's the next year kind of hold for us. This slide really just shows you what the various activities are. So Block 22/12, we've got our hands full there in really fulfilling and executing on the 12-8 East Phase 2 drilling program. That will take us through to the end of the first quarter. There's a constant focus on upgrading water handling capacity at our fields in Block 22/12. What's very important to recognise is the more water we can handle in Block 22/12, the more oil production we can sustain. There's a big focus on upgrading water handling. Further focus on some infill drilling targets, and we'd hope that towards the latter part of the year, we can mature a couple of other infill well opportunities to keep that sustained production levels. And at Maari, I mentioned we've got a couple of pretty key workovers, one which is underway at present. And then there's a third one which involves some further water injection enhancement into the field, again to sustain production levels. And I've already mentioned Maari life extension being a focus area. So let me conclude by summarising and emphasising the group strategy and how we've planned to deliver against it in 2023. We've commenced FY23 with exceptionally high production rates and sustained high oil prices, which bodes well for continued strong free cash flow generation. As I mentioned, our production rates are currently about 40% higher than the average for FY22, and that bodes pretty well for cash flow generation. At Beibu, our priority is to optimise production and continue to enhance production rates through that constant focus on further infill drilling, workover activity and upgrades to water handling capacity. And at Maari, our focus is to restore production from the wells that are currently shut in, and really work with the operator looking to the future and how we can extract maximum value from the asset. In terms of further distributions to shareholders, we're determined to deliver value to shareholders, having delivered consecutive returns of 48 million Australian dollars this year, 47 million dollars last year, and further capital management initiatives are under constant review, as Mike mentioned. In terms of investing in production growth, as I mentioned, our focus is continued investment in our existing assets, trying to deliver value, and our first priority is the 12-8 East Phase 2 development, closely followed by further infill drilling and the workover activity at Maari. We keep a constant eye out for opportunistic inorganic growth opportunities, which could further enhance shareholder value, but we'd only really look at these if they provided exceptional value and continue to enhance our ability to provide distributions to shareholders. And whilst our business continues to face challenges, I'm very lucky to have a very capable team working with me, and I feel that we're in a very strong position to navigate the challenges ahead and continue to deliver value to shareholders. Thanks, Mike, and I'm happy to answer any questions.
Thanks, Richard. I'd now like to provide an opportunity for questions on Richard's presentation. There'll be an opportunity to ask questions on the formal business of the meeting later. And I'll endeavour to give everybody a chance to speak for a reasonable time. So questions for Richard, Mayor and the team. Oh, Charles, one.
In all stuff that I've read, I haven't seen anything on sort of sovereign risk in China. I assume that means it's very low as far as you're concerned. But what is your thinking there?
We're quite fortunate. We have a very good relationship with particularly our joint venture partner, CNOOC, and particularly through our other non-operated party, Rock Oil, who are owned by the Fosun Group, and again provide us that connectivity through to the Chinese. Realistically, we're essentially a domestic producer in China. China's got an insatiable demand for oil, and we bring to the table our own Western expertise. Through this 12-8 drilling program, we're providing constant feedback and suggestions on well trajectories, and so they really value our input. On sovereign risk, if I was honest, I think it's more the other way around. It's more Australia and what Australia does, and Australia's reaction. I'd like to think what we've seen in the last 24 hours is perhaps a softening of our stance and more cooperative position. But certainly over the time horizon of this asset, I mean, it runs out through to 2028. We recognise its potential risk, but not something we're particularly concerned on, certainly in the nearer term.
Questions?
Yeah, Andrew Beach, my name. You mentioned earlier in the presentation about any opportunistic potential additions to the portfolio. You mentioned exceptional new business opportunities. When we look back over the last few years, there was only the transaction with Owen Energy. I think that was truly exceptional for one of the partners. Could you perhaps give us a flavour around about the opportunities you've been reviewing over the past few years, and perhaps one or two which you came close to looking at potentially purchasing?
I'll have a go at the start, Richard.
Yeah, no, please.
It's fascinating because when I first came 3 years ago, everybody wanted to turn the bells off, go home and give you all the money, right? That's all that's happened. When you look at what's happened over the last 3 years, when I first came, the production was off in about 2020, 27, whatever the year was. We might as well pack up and go home. But what we've done over the last 3 years that Richard's talked about is we've kept that production flat, and you've seen the revenues from it. What we'd like to do for the next 3 years is keep that production flat again. It's getting harder every sort of tranche you look at because the reserves are declining. But that's our big job. That's our main job. Now, we've looked at lots of things which Richard will talk to you about in a minute. But I don't think we're interested in long-dated black oil assets that go through the exploration phase and they don't get any revenue from it for 10 years, even if they do. It's got to be free cash flow accretive more or less straight away, and hopefully in our own backyard. Now, they're the three things that, once you start those three things off, you narrow it down just like that. But they're the three things we put on top of these growth options over and above our production. You talk about it.
Yeah, I mean, I'll just sort of add to that. Look, we've looked at a lot of opportunities. I mean, every other week we get things across our desk. Have we seen anything particularly compelling? Not really. Nothing that we've really gone too far down the path of, and it's really because we've got a fairly sort of narrow sort of level of capital to be able to deploy, and quite frankly, the best value we can have is investing in our existing assets. You can see that what we've been able to unlock out of China. It's not to say we won't go after things. We certainly look for value, and I think really where we would like to think the opportunities will come from is as the bigger companies start to divest out of fossil fuels, then we have the opportunity to pick up some of those assets they may not be quite as, you know, their desire for value on exit, you know, maybe a little bit more relaxed, and hence that would be the opportunity for us. But we're patient, and we don't have to do anything. These assets are good, and certainly for extracting value for shareholders, this is our main game, is focusing on what we've got.
So you're pretty much ruling out any development assets going forward?
It'd have to be very close to development. We're certainly not interested in, you know, exploration opportunities, anything particularly long dated. We've looked at, you know, some assets approaching development, but with that comes a load of risk, and similarly comes with that funding challenges, which are only getting more difficult. So, you know, that's not to say we wouldn't consider them if they were really compelling value, but certainly that's not the core focus.
Brad, can I just, Mr. Chairman, can I just ask a question that sort of follows on from that? Richard, are we in sort of, opportunity doesn't knock very loudly normally. Are we sort of in passive mode? Are we waiting for deals to sort of come in the door, or have we got people in the organisation or consultants or whatever proactively looking?
Yeah, look, we do have people proactively looking. I mean, again, our focus of the core team is internally on these assets, but we do have some consultants working for us, looking up in Asia in particular, and we're pretty tapped in the local market, various investment banks and so on. But we're not spending an inordinate amount of time on it, but it's you know, we still think there's opportunity to be had.
Most of them, Brent, are looking for our cash.
Yes.
That's a problem. They want our cash, and we get that.
Yeah, I mean, we've had,
sorry, go on, Richard.
I mean, we've had a lot of people knocking on the door with, you know, big development projects, and naturally we see us like a bank. But, you know, we're pretty quick to sort of bat them away generally, because, you know, what they think their assets are significantly higher value than what they potentially are, given the risks involved, and generally don't place the same level of value on our assets, which are clearly highly cash accretive. So it's, you know, tends to be pretty focused and careful.
According to my model, I calculate that with a reasonable price expectation, oil price, we'll have around about in excess of $200 million in cash at the end of financial year 2026.
You're not telling me that, Richard. You've got the decimal point in the right place.
It on the way.
If I go to the Petra research, which is the only research on the company, their number is actually $222,000. Okay, so we might both be mugs, but we're getting the same answer. That's a hell of a lot of cash, and I just think, you know, I just wonder whether it's worth having a bit more proactive look at new opportunities. I agree with the strategy, the current strategy, the focus on squeezing the lemon with what we've got. We're at a very good time in the price cycle for doing that. This is where, if you go back to the US over the decades, over the century, this is where people made money, by sort of really squeezing what you've got hard during good price cycle. But anyway, I sort of agree with your sentiment. I don't agree that we don't have any capacity to do deals. I think we've got a lot of capacity to do deals.
Oh, no, yeah, look, perhaps don't misinterpret what I've said. I mean, we are focused in this area and looking for opportunities, and we are being proactive. I just don't want you to take away that we're so focused on that we're not spending the appropriate time on our existing assets in squeezing the lemons.
A lot of what I've seen, Brent, you know my background, they're in Timbuktu, the other side of the world, which doesn't thrill me much. And they're all going through an awkward, if you want, appraisal development phase where the small ones have run out of cash, haven't got any, and it's, give us your cash, please, and let's get on with it. It's good and bad in that. are all in that appraisal, exploration, development phase where you well know it's full of pay.
Yeah, it's also, I think, at the moment, based on the deals that have come across our desk, the price expectations are still quite elevated by the sellers, focused in and around, you know, the heightened oil price. So we need perhaps a bit of a softening in those price expectations to really help us to sort of find the deals that would be accretive enough.
The term exceptional in the current oil environment is going to be very hard to achieve. I would say that's unattainable in this current environment, especially if you're only looking at producing assets versus development assets. Like you said, that's where the opportunity seems to lie for exceptional new opportunities in the industry. Just a comment.
Yeah, look, we're picky. We're being picky. I'll be honest, candidly. That's why we haven't done something for the last 3 years. But you know, I think the opportunities are there. It's just it's got to be judicious about it. And again, we're not an urgent hurry. It doesn't have to happen tomorrow. So we'd rather wait for the right deal to come along and jump into something.
Okay, there's a gentleman on the end there.
It's Peter Brereton, proxy for my super fund. I commend the company for its emphasis on cash generation. I think that's really important. So I'm wondering why the company's wasting money on purchasing carbon credits when there's no fines or penalties for current emissions.
Yeah, look, we've got a pretty judicious approach to that, and we're trying to make the right impact as we go along. Those carbon credits, you know, were purchased in China for a community-based project. So they were, on the one hand, they had the environmental benefits, but probably just as important, they had the social benefits. So this was the methane digesters for some rural communities to help them to essentially displace burning coal and timber for cooking and using the byproduct from their animals for cooking. So we see that, and it sort of goes to the political risk side, trying to help the community in the area we operate, as well as having, I guess, the added benefit of providing some offsets. But I would just highlight that, as I mentioned, it's not our desire, but my desire to focus on purchasing offsets. I'd much rather direct emission reduction initiatives, and certainly in New Zealand, that means dollars for us. So it's, you know, there's an emission trading scheme there. We're paying $85 a tonne for carbon emissions in New Zealand. If we can reduce emissions there, we're saving $85 as well as not having to burn crude oil for power generation. So there's an economic rationale for focusing on carbon reduction initiatives, certainly in New Zealand.
I don't know whether it's carbon credits, but you saw we renewed the loan, the $20 million loan we had. And I know from Richard's experience, the banks wouldn't have given us that if we weren't somehow addressing that subject. And not that I want to borrow any more money, but we want to go that route. You won't get any unless you've got some sort of strategy that they believe in. And a lot of them won't touch it anyway because we're black oil.
It was a fairly modest amount, I suppose, is what I would also.
I've got another question.
Yeah, go on.
What's the risk of not getting the lease extension in New Zealand? Because the current climate over there, the Prime Minister's pretty woke, and I really think we've got a major risk there if that sort of attitude continues in New Zealand political scene.
Yeah, I suppose I'd probably have to look at it the other way. I mean, our current portfolio, our current reserve position is focused on production through to 2027. The opportunity is there for an extension. You know, it's not a given. I would agree with that. You need permits, you need extensions to permit. There's other sort of permits that we would require.
But you need the politicians on site. That's what you need.
Well, you do. I think you know, it's probably a positive with OMV staying in there that they probably have a little more capital with the government and with the regulators to to gain that, given, you know, Maui, Pohokura and their other assets. But yeah, no, it's certainly an area we're going to need to work pretty hard, and that's certainly a current focus.
I think that's really worth pursuing, because A, it pushes our environmental, our P&A liability, pushes that out. And looking at your production forecast, if you like, you know, you've got production out in 29-30, about where it is today, and it's very profitable today.
Yeah.
So, you know, it just sort of doesn't make economic sense not to push it out. I think where the company's done well, obviously in China and in New Zealand, you're very well aligned with the operator. That's quite clear from the presentations and the results. And I know, as I understand it, there's a good relationship there with OMV. OMV have always been a bit kind of timid. They wanted to shut the field down, as I recall, in about 2023. Are they sort of, you know, have they got this idea as well, as trying to push things out beyond?
Yeah, look, I mean, it's obviously only been, you know, the dust only settling after the transaction being terminated. But, you know, what I can say is perhaps, I mean, you're aware there's decommissioning legislation that's out there, and it actually requires you to fully decommission by the end of the permit date. So it's dawned on OMV that that's not gonna fly. So there's certainly momentum building for, they're gonna need an extension come what may. And, you know, we really want to drive and push them to extend it out at least 5 years, and, you know, get that incremental production and the further decom.
Beyond the current close, the current end date.
Yeah. So but we're seeing some positive signs coming out of OMV, but it's early days.
Oh, sorry.
Yes, sorry, just Phil Barrington. Just a quick question. What's the biggest risk to these capital returns? Is it the macro oil price big picture, or is it these operational sort of, where's the biggest risk to the return to these 3 cent returns that we're getting? What do you see?
Look, it's oil price and production. I mean, they're the core parts. I mean, I'd like to think that having the 2 assets, and now within China, you know, and a third field there with the 12-8 East field, that helps to sort of diversify sort of production flows. But clearly oil price, I mean, yeah, you can see that our cash flow is pretty sensitive to oil price.
So you're more confident in at the operational level, you've got a handle on that. What you can't control is the oil price, the macro, but at this level, you're more, the bigger risk is at the oil price level.
Yeah, I mean, there's always risks at the operational level, and we manage that through workovers. But, you know, these fields have been in production for, you know, 9+ years. So yes, we will have small intermittent workover issues and so on, but the general fields produce, we know how they produce. It's more the, you know, the oil price, and obviously, you know, we can undertake hedging to help us in the short term to mitigate that.
I think on the oil price, what's going for us is that if I can ever get a straight answer from these accountants, you know, our lifting car production costs are about $30 a barrel. So we're still okay if it drops to that, unless you put another number now, Richard, which you won't tell me.
No, that's right. Yeah, so we've got very low operating costs, which means we've got good cash flow, but you can imagine the incremental value of an extra $10 a barrel really helps to drive.
But at what level is that 3 cents? So for example, if oil dropped to 60, would that 3 now be not feasible, and then we're looking at maybe 2 or so? What level is that 3?
Yeah, probably something like that, yeah.
Right.
Yeah, I mean, at the moment, we're going through a particularly capital-intensive phase. So we've drilled 14 odd wells on the trot. So, you know, that means we've got a higher overall cost, if you include the capital cost in the, but, you know, once we get past March, we don't have a huge commitment on capital after that point, such that if the oil price were to fall, we'd still be very, very cash accretive.
Okay, any more on this Richard section?
Just one.
Oh, sorry, well, somebody else as well, there's 2. I don't know who else.
Yeah, one at the back.
Oh,
Yeah,
okay.
go.
Why did we get a capital return why did we get a capital return and not just a bigger dividend?
Like, good question. I mean, we've been, you know, we were agonising over what's the appropriate mix of distribution, whether it's buyback, capital return, dividend. You know, we've got a broad array of shareholders. We've got foreign shareholders, domestic shareholders, people holding in their super funds, retailers, you name it, instos. And so we looked at what's really the optimal solution for the greatest number, so to speak. You know, capital returns can be favourable certainly for your retail shareholders. For the foreign shareholders, to be honest, whether it's capital or dividends, it's kind of ambivalent. Probably their biggest risk or concern is what does the ATO think of a capital return when it's handed, or indeed a buyback, and whether they would deem any part of it to be a dividend, regardless of what the company might call it. And so we engaged with the ATO to really see what was going to be palatable, and this mix kind of was the level which they were comfortable with, and gave us sort of a notional endorsement on, and again trying to balance what's good for as many shareholders as we could cover.
Okay, but there was...
Yeah, it's just in relation to what the board thinks about the current share price. They're happy with the current share price range. The capital growth in shares seems to be within the range of the capital return / dividend. Are you happy with the current trading range? Would you like to see that higher? And perhaps why don't you see the board investing themselves in buying shares in the company?
I'd like to see it higher, yeah.
Yeah, I've always liked to see it higher.
Can't make it higher though. I mean, you guys make it higher. When I watch it go up and down, and there's not much liquidity anyway, as you know. So it seems to float up to 13 cents and then down to 10 on whims and fancies of the marketplace. And I'm not particularly keen on buybacks. I don't think that will change much the share price. And I don't know if we all got shares.
I don't, but that's a philosophical position I hold on.
I don't recall seeing many purchases by directors in the last 2 or 3 years.
Like a number of the directors do have shares, but not all.
Without meaning to be rude to anybody, can we have the last one and then we'll move on, please?
Okay, you prompted my question. What's in the company's franking credit account?
Not very much.
So dividends, the next dividend will be unfranked, will it, or?
Look, if we were to, absent something significantly changing, if we were to pay a dividend, it would be unfranked.
Okay.
Okay, if we can move on. So, given that the notice of the meeting has been sent to all registered members, I now move the notice of the meeting to be taken as read. The minutes of the previous annual general meeting have been approved and signed in accordance with the Corporation Act, and a copy is available for inspection of the rights and opposition if any member wishes to do so. We'll now move to the business of the meeting, which includes the resolutions to be put to the meeting. Prior to each resolution being discussed, the proxies that we receive for those items will be displayed. As I mentioned earlier, all resolutions will be decided by a poll, and a live vote is now open on all items of business. So the first item is the financial report. To consider receive the financial report, director's report, and independent auditor's report for the year ended 30th of June 2022. These documents have been made available to all shareholders. There's no requirement for shareholders to approve these reports. Accordingly, item number 1 is for discussion only, and there will not be a vote on this item. I remind you that only shareholders of the company or their duly appointed representatives or proxies are permitted to ask questions. So we've done a lot of the more general stuff in the last 20 minutes. So anything on those reports that you'd like to ask? No? Okay, let's go on to item 2, adoption of the remuneration report. The meeting now needs to consider item 2, adoption of the remuneration report for the year ended 30th of June 2022. The board unanimously recommends that shareholders vote in favour of this item. proxies received in relation to this item are displayed on the screen, and it's now open for discussion. Gosh, that must be a first for any remuneration report, no questions. So item 3A is the re-election of me as a non-executive director. I'm retiring by rotation in accordance with the constitution of the company, and being eligible, I'm standing for re-election. As I have stood down from the board, I'll now hand over to my fellow director, Sandra, to chair this item.
Thanks, Mike. The proxies received in relation to this motion are displayed. The other directors unanimously recommend that shareholders vote in favour of this resolution. Before we open...
Oh, ignore that, sorry.
All right, okay. There is now an opportunity for discussion on this resolution. Are there any questions? No? No questions? That's okay, I should have crossed it out. Thank you very much, ladies and gentlemen. As Mike has been re-elected, I will now hand over the chair of the meeting to him.
Thank you, Sandra, and thank you. Item 3B, the re-election of Bruce Clement. Bruce Clement is retiring by rotation in accordance with the constitution of the company. Being eligible, he is standing for re-election. The proxies received in relation to this motion are displayed, and the other directors, including me, unanimously recommend that shareholders vote in favour of this resolution. There's now an opportunity to discuss this item, if you'd like to. And we'll move on to item 4, the renewal of proportional takeover provisions. The meeting now needs to consider item 4, approval of the renewal of the company's takeover provisions contained in the articles of the company's constitution for a period of 3 years in accordance with the Corporations Act. Proxies received in relation to this motion is displayed upon the screen, and there's now an opportunity to discuss that. Okay, thank you. Item 5A, approval of the Managing Director's long-term performance rights incentive. The meeting now needs to consider item 5A, approval of the Managing Director's long-term performance rights incentive. The details of the long-term performance rights incentive plan are outlined in the notice of the meeting. Proxies received in relation to this motion are displayed upon the screen. Questions? Excuse me. If not, we'll go on to item 5B, approval of granting of shares for the Managing Director's LTI. The meeting now needs to consider item 5B, approval of the grant of rights to ordinary shares to the Managing Director as a deferred component of his 2022 short-term incentive. The details of the short-term incentive are set out in detail in the notice of the meeting. Proxies received in relation to this motion are displayed upon the screen. And again, there's now an opportunity to discuss.
Yes, broadly speaking, I'm in favour of this resolution and the one before, which because it puts incentives into the in front of the CEO. I think that's good. I must say though, not so much on the 5B, but on 5A, which was the LTI.
The LTI one, yeah.
I know that it was set out with some care in the notice of the meeting, but I must admit I had a bit of difficulty sort of working out how it works. I just wondered if there's a sort of an idiot's guide, summary of, well, is there a short explanation as to how it works?
I thought it would be simple compared to essentially it's a one-off grant.
Yeah.
We wanted immediate alignment to all shareholders rather than this perpetual, this motivation to stay year on year and capture more SARs and whatever the share price might be. So it's essentially to motivate key management employees, personnel, to become shareholders as quickly as possible. That was the same rationale for the 50/50 on the STI. Right? So this is essentially if the share price hits each hurdle over a 30-day VWAP, and there is post that a $25 million in aggregate trading of shares at or above that VWAP, so we want that share price hurdle sustained, then and then the 5-year vesting window. So essentially, with other bells and whistles, the first hurdle is a 30-day VWAP at which are the hurdle prices, and that was 13 cents to 20 cents, which has obviously been reduced to the capital dividend returns, so it's now 10 to 17 cents. And then in that 12-month window, post that VWAP hurdle being hit, there needs to be $25 million worth of shares traded at or above that VWAP as the second key vesting condition. There are other vesting conditions. So essentially sustain that higher share price, and then they come out as shares. So the SARs were options, and these come out as shares.
Can I just put this sort of hypothetical to you? If, for example, the share price went to 17 cents tomorrow, and it stayed there for the period, and if in the next 12 months there's $25 million worth of shares traded, at the end of 12 months, does that mean the 19.6 million shares are assigned to the CEO?
Well, it would be at the end of that $25 million
25 million.
traded. We know that will vest once the $25 million is traded.
The whole
that share
19.6.
Well, you've picked the 17 cents because it's the grain, the top one. So yes, in the instance of 17 cents, because that's the highest threshold,
Yeah.
or 19.6
Right.
But if it was 13 cents, only the tranche is up to 13 cents. So it's 7 million, then they dribble out. So there's 5 tranches. So yes, if the highest share price hurdle has been met and the bond value has traded at those levels, then they will by default be vested.
And once those shares are assigned, is there any escrow or any holding period? So in other words, the recipient could actually go out and sell those shares on the market. Right.
Subject to the trading policy, yeah.
Subject to the trading policy.
Now, Brent, I'm in your camp. I'm more than happy that you could spend some more time with Greg working. It's something, that everybody struggles with, this LTI and investing. So I'm happy that you do, rather than drive everybody mad.
Also, we structured that second to make sure the share price was sustained. So at that point in time, they've done their job.
Yeah, no,
Was our view.
I
Other shareholders, you've all had an opportunity to exit whilst these guys are adding up to get the $25 million. You can always finesse these things further and put more bells and whistles on it. We thought that was a pragmatic approach.
Before we move on to the polls, I'll just like to say thank you, just on a couple of things. I think we're a good little company. When you look at our peers, well, who's given back $100 million in the last 2 years, is it? And all things being equal, it's likely in the future. Don't hold me to it. And in terms of growth options, yeah, we're with you on the growth options, but they're few and far between. When you look at the criteria we said a few minutes ago, they're really bloody difficult to find, unless you want to spend some money and take some risk. I'm not sure we can find any that outweigh that risk and they give us cash. So where we are today, I'm very pleased with it, and we should thank everybody, because as I said before, the last 3 years we've kept production flat. Next 3 years, hopefully we can do it again. It's getting harder all the time, but what a nice little company it is now. So let's get on to the polls. We'll now conduct the polls, and I invite Cass to sort out what we're doing on the polls.
Thanks, Mike. So Gemma Coyle of Computershare Investor Services has been appointed returning officer for this meeting, and I am satisfied as to Computershare's independence. If there is any person at this meeting who believes they are entitled to vote but have not yet registered, would you please raise your hand for assistance? Every member present in person or by representative, attorney or proxy who holds a yellow admission card is entitled to 1 vote for each share held. The resolutions on which you are required to vote by poll are items 2, 3A, 3B, 4, 5A and 5B are set out in the notice of meeting.
Thank you, Vass. Well, we collected all the votes. They've got over there. Well, I should doing that.
Mike, that's
Have I done mine?
There you go. Just the chair.
Brent, whilst Brent's filling you in, you know the format here. We'll send this to the ASX and we'll get the results issued this afternoon. That's all right.
Anybody else who'd like to come to vote?
So thank you once again for coming, and I'll declare the meeting closed.